All right, let's dive into one of the most brilliant economic minds of the 20th century, John Maynard Keynes. But we're not here today to talk about his economic theory. Nope. We're here to deconstruct his largely overlooked career as a pioneering and, at times a deeply flawed investor and institutional asset manager. Keynes just got it. He had this unparalleled understanding of market psychology, what he famously called animal spirits. He knew markets weren't always rational. But for those of us who operate in these markets professionally, this begs a really critical question. I mean, you'd think a man with his profound insight into the macroeconomy would be a prodigy from day one, right? But the archival data from his time managing the King's College endowment and his own personal accounts, well, they tell a much more interesting and much more human story. In fact, it was a story that started with a near catastrophe. Following the commodity price collapse after 1928, Keynes personally lost a staggering 80% of his portfolio. This wasn't just some setback. This completely shattered the myth of the infallible genius. Okay, so let's really dig into this early period. To understand the investment revolution Keynes would later pioneer, we first have to deconstruct the failure that made it all necessary, starting with his stewardship of the King's College endowment. His initial record was, let's just say, far from stellar. By August of 1929, the discretionary portfolio he managed was lagging the UK equity market by a cumulative 17.2%. His economic genius simply wasn't translating into alpha. So, what was going wrong? And here's the crucial thing. Keynes's early investment philosophy was built on an idea that so many investors still fall for today, this belief that you can systematically time the market. It was a thesis that even a mind of his caliber just couldn't execute successfully. He called it the credit cycle theory of investment. He was absolutely convinced that his skill in macro forecasting would allow him to perfectly time switches between asset classes. Ride equities up, then jump to the safety of bonds and cash just before the downturn. It was a classic top-down macro-driven strategy. And you don't have to take my word for it. Here it is, in his own words from a 1938 internal memo. He admitted failure. He confessed that this kind of credit cycling required phenomenal skill to make it profitable, skill that he flat out admitted he did not possess. This intellectual honesty, it would become his greatest asset. So this buildup of failures, all culminating in the 1929 crash, forced a profound, career-defining transformation. Around 1932, we see what academics call a structural break in his investment process. And when I say pivot, I mean it was a total pivot. He completely abandoned top-down speculation on market direction and embraced a bottom-up, fundamental analysis of individual companies. He literally transformed from a macro timer into a genuine stock picker. This timeline really illustrates the pivot in action. Just look at his reaction to the two major crashes. In 1929, when he was operating as a market timer, he sold into the fall. But in the 1937 decline, armed with his new philosophy, he did the exact opposite. He either held his positions or he added to them. The proof isn't just in his words, it's right there in his trades. And the performance data? Well, it backs it up completely. In that early period, before the pivot, the average one-year performance of his stock purchases underperformed the market by 5.3%. He was actively destroying value. But after his great pivot, that exact same metric flipped completely. His stock picks now outperformed the market by an average of 5.4% in the year after he bought them. I mean, this right here, this is the statistical evidence of a newly discovered durable analytical edge. So what was this new edge? What were the core components of this successful approach that we, as modern investors, can analyze and really learn from today? It's remarkable, really. His new philosophy anticipated so many of the principles of modern factor investing. He built these idiosyncratic, high-conviction portfolios. He had a clear tilt towards the small-cap premium and, crucially, the value premium, focusing on stocks trading below their intrinsic value, often with high dividend yields. And he did it all through highly concentrated bets. You can see his high-conviction approach so clearly in his sector rates. This wasn't some closet indexing. He created a portfolio with massive tracking error, taking huge overweight positions in sectors like mining, while holding zero, literally zero, exposure to market leaders like banks or oil. This level of concentration is just incredible. The majority of his portfolio was often in just 2 sectors. This demonstrates his new philosophy in action, putting, as he wrote, fairly large sums into enterprises which one thinks one knows something about, and in the management of which one thoroughly believes. But his edge wasn't just analytical, it was behavioral. He identified this crucial trait he called equanimity, which is basically the mental fortitude to watch your holdings decline without panicking or blaming yourself. This is what allowed him to act as a contrarian and hold his nerve during downturns like 1937. He also completely revolutionized institutional asset allocation. At a time when endowments were shackled to fixed income and real estate, he saw equities as the future. In the portfolio he controlled, he pushed the equity allocation aggressively above 50%, while the restricted, rules-bound portfolio held barely 1%. This was as radical then as the move into alternative assets was for endowments in the late 20th century. So, after this incredible journey from failure to success, what's the ultimate takeaway for investors today? What is the core lesson from Keynes's long and winding path? Look, the really crucial point here is that Keynes's most valuable lesson isn't a specific strategy. It's the process itself. It's the evolution from the hubris of a macro timer who thinks he can predict everything to the humility of a bottom-up investor who knows he can't. This famous quote, and yeah, its attribution is debated, but it perfectly captures the spirit of his great pivot. He recognized the limits of his own forecasting ability and shifted his focus to a durable, value-driven, and behaviorally sound process, but only when the facts of his own underperformance became undeniable. And this really leaves us with a final thought for today's markets. In an era that's so dominated by quants and big data, maybe the greatest, most durable edge we can cultivate isn't found in our models, but in our mindset, in that very human capacity to admit when we are wrong and to evolve.